And the goal of this distribution of resources is to be more risk-based and to focus most of our resources on the banks, which are more systemically important. On the other hand, on the right side, you will see the other departments, which are specialized risks department and supervisory policy department. So these departments are looking at specific risks across the whole banking system. Under the specialized risks department, we have risk specializations in several different divisions and groups. These are corporate and retail credit risk. This is liquidity risk, operational risk, market risk, cyber risk, and business model and profitability. And under the supervisory policy, we also have corporate governance and group structure risk assessment. So on the left-hand side, you see all the risks that we are looking at, the corporate credit risk, retail, market risk, and so on. And on the top row, you see different banks. So in each bank, each risk has two assessors. So we have somebody from the banking supervision team that is looking at this bank, and we have somebody from the risks team who is looking at the specific risk. And this is how the system works. In addition, the risk supervisors are also looking at macroprudential risks. So they're looking at systemic risks across the whole banking system. And this is an important feed into our overall assessment. And in addition to looking at the banking system, the macroprudential team is also looking at other macro indicators they collect from our monetary policy colleagues or statistics department in order to have a better assessment and understanding of macroprudential risks.
I want to describe what are the gray process scoring versus the SREP process. On the left-hand side of the slide, we can see that there are several categories of the gray process, risk categories. And for each categories, we have the relevant risk weight, and also we have some inherent risk and mitigant. For all the categories, the first step is to assess the inherent risk and also the relevant mitigant. And only after this, we have the net risk for each category, for each risk category. The score starts from 1 to 5, and the 1 point means that the lowest risk and the 5 corresponds to the highest risk. The first step, as I said, is that we have to assess the mitigant and the inherent risk and the final net risk score. To compare with the gray process to SREP scoring, we can see that in case of SREP scoring, there are only points from 1 to 4, and also we can see that the SREP process may result in an early intervention and resolution measures.
Credit risk assessment is based on continuous supervisory assessment process for large corporate borrowers and exposures, as well as point-in-time assessment of SME and retail loans based on sampling and extrapolation, considering the tremendous amount of loans. NBG has developed historically very advanced and comprehensive reporting system, which generally gives us the ability to have a very close touch with banks and understand what kind of underwriting standards, especially for retail loans and risk tolerance they have, how they compete with each other, etc.
In this stage of banking sector development, in regards to market risk, we have two major risks. This is FX currency position risks and interest rate risks. The starting point of a market risk assessment is a traditional, and we begin with assets and liability structure assessment, and also we look to the maturity and assets and liability gap. In addition, in terms of evaluating FX currency risks, we mainly observe aggregate currency position in main currencies and also the compliance of to regulatory limits. For example, in terms of FX positions, we have open currency position limit, which should not be exceed the 20% of the bank capital. And we pay a lot of attention that the bank should not breach this limit.
Maybe one last question, Popuna. I think you made a very important statement. You can limit risks, you can assign high capital, you can control somehow. But if your corporate governance is very weak, that means your bank is in danger. And when I look at slide 5, you assign risk weights to scores of different risks and corporate governance. In that respect, for example, if corporate governance of a bank is very bad, it's 5. Can this bank receive a score of 2 as a result of the formulation here? Or do you have some kind of expert judgment to override the score coming from the formula?
Mm-hmm. Yes, so we don't have expert judgment in the GRAPE assessment, but if the corporate governance is really poor in the bank, it's not only 15%, because part of the mitigants that we see in each risk will also be rated very low. For example, for the credit risk, if we have 5 assessment in the mitigants, this will damage the credit risk score significantly. So it's not only the corporate governance score we assign for the corporate governance section, but if the risk governance is poor in each of the risks, for example, credit risk, operational, this bank will also receive a low score in that particular risk.